All right, let's dive into a really interesting company today, Revenio Group. It's a specialized Finnish health tech firm that's become a pretty big deal in eye diagnostics around the world. And from an investor's point of view, it's a fascinating one to unpack.
And that really gets us to the heart of the matter, the big question we need to tackle. See, Revenio has all the signs of a fantastic, well-protected business. The problem is, the market knows it. And that means its stock comes with a pretty steep price tag. So the real puzzle for any investor is, how do you balance that incredible quality against a price that demands perfection?
So to understand what makes this company so special, we've got to start with the core technology. This is what gives them their powerful competitive edge, their moat.
Okay, so at the very core of Revenio's business is this patented technology called rebound tonometry. Now, you probably know that uncomfortable puff of air test at the eye doctor. Well, this technology replaces it. It uses a tiny, super lightweight probe that just momentarily touches your eye. It's way faster for the doctor, and believe me, it's a whole lot more comfortable for the patient. It's one of those simple, brilliant solutions that's the bedrock of their whole advantage.
And listen, this isn't just some clever little gadget. This tech is validated by over 200 clinical studies. That is a huge deal. It creates this massive scientific moat that makes it incredibly tough for any competitor to come in and challenge them on the data.
And they're applying this tech to the really big problems in eye care. Through their iCare brand, they're doing way more than just checking for glaucoma. They're actually building out a whole ecosystem of tools, including things like advanced retinal imaging, to help doctors spot these major, sight-stealing diseases, like diabetic retinopathy, as early as possible.
So, you've got a company with a strong tech advantage, but how does that turn into a great investment? Let's build the bull case. What are the key reasons you would be optimistic about where Revenio is headed? First off, Revenio is basically surfing some of the biggest waves in modern healthcare. We have an aging population globally, which means more eye disease. We have rising rates of things like diabetes, which means a huge need for screenings, and healthcare systems everywhere are desperate to be more efficient. These aren't just short-term trends, these are powerful, decades-long tailwinds pushing the company forward. The second piece of the bull case is a really smart shift in their business model, something investors absolutely love to see. They're moving away from just one-time sales of equipment, which can be lumpy, to a much more stable model based on recurring revenues. It's the classic razor and blades play. They sell the device, the razor, and that creates a steady stream of income from selling the disposable probes, the blades, over and over again. And this isn't just an idea for the future, it's already a huge part of their business. These high-quality, predictable revenue streams now make up nearly a third of their total sales. As that slice of the pie gets bigger, it just makes the whole company safer and the earnings way more reliable.
And finally, the financials. Wow, they are just rock solid. We're talking gross margins up around 70%, which screams pricing power. Their balance sheet is a fortress. They've got more cash than debt. They generate a ton of cash, and they've been paying dividends for 10 years straight. That kind of financial strength is a massive green flag.
Okay, that all sounds fantastic, right? A great business, great financials, huge tailwinds. But a smart investor always flips the coin over. So what could go wrong? What's the bear case against Revenio?
Well, one of the biggest risks becomes obvious the second you see where their sales come from. Look at that. Almost half of their entire revenue comes from one single country, the United States. And putting that many eggs in one basket always creates a few vulnerabilities. So what kind of vulnerabilities? Well, two big ones. First, currency. They report in euros, but make a ton of US dollars. If the euro gets stronger, it can make their sales and profits look weaker on paper, even if the business is doing great. And second, there's the political risk. Heavy exposure to the US means they're vulnerable to things like import tariffs, which could just pop up and take a direct bite out of their profits. Beyond just geography, there's a ton of pressure on them to execute. Their growth depends on them being pretty much flawless, from their R&D to new product launches to integrating acquisitions like this new AI company. And they have to do all that while going toe-to-toe with absolute giants of the industry, companies like Carl Zeiss and Halma that have way, way deeper pockets.
But honestly, the absolute heart of the bear case comes down to the price. Just look at these valuation numbers. Revenio is trading right up there with its biggest rivals. This is no hidden gem. The market already knows it's a great company, and it has priced in a huge amount of future success. And hey, that's not just my take. The analyst community is pretty clear on this. They say the valuation demands serious growth and leaves very little room for error. Any stumble, a product gets delayed, a competitor makes a move, could cause the market to seriously rethink that premium price tag.
So where does that leave us? You've got this high-quality business on one side and this high valuation with some very real risks on the other. How do you square that circle as an investor? Let's just boil it all down. Number one, you've got an A-plus business, a leader in its field with a great moat and the wind at its back. Number two, that business faces very real risks from things like currency swings, tariffs, and huge competitors. And number three, you have to pay a top dollar price for the stock that already assumes they're going to navigate all those risks perfectly.
And so it all comes down to this one pivotal question. Management is making all the right moves, pivoting to software, integrating AI, but can they execute flawlessly enough to deliver the kind of spectacular growth that's already baked into that stock price? That is the trade-off you have to weigh.